Okay, let's unpack this. Imagine a single three-digit number, maybe, of four digits, depending on where you are on the planet, that quietly holds this immense, almost career-defining power over your life.
Hmm.
We're talking about the ultimate, ubiquitous global report card, your credit score.
Right.
I mean, this metric determines whether you can rent that apartment, get that crucial phone contract without a massive deposit, or, secure the capital to launch your own business. It's huge.
It is huge. And the power of that number is, I think, often invisible and just taken for granted until that one moment you truly need to use it.
Exactly.
And at its core, a credit score is defined as a numerical expression. It's based on a really sophisticated analysis of a person's financial files.
Files that come from credit bureaus, usually.
Usually, yeah.
Yeah.
Information sourced from credit bureaus to represent that person's creditworthiness. It's really designed to be a simple, quantifiable prediction of risk that a lender can easily digest.
But the moment you cross an international border or even just dive into the regulatory fine print, that simple, quantifiable number becomes anything but universal.
Oh, absolutely.
We are diving deep today across systems in 14 different countries to see these massive differences in, core philosophy, in the data they are willing to use, and crucially, in the consumer rights built around that all-important number.
And our mission today is, I'd say, twofold. First, we want to extract the crucial insights that explain not just what your score is, but why the approach varies so wildly across the globe.
Right.
And second, we want to show you this fundamental philosophical split. We're going to see these highly commercialized systems built purely on proprietary statistical prediction right alongside, these really rigid systems built on government enforcement and stringent privacy controls.
It's a fascinating and often contradictory look at how different societies define financial trust.
It really is.
So let's start with the basics of function, but, immediately expand the scope. When most people think about their credit score, they think about applying for a mortgage or maybe getting a new credit card. That's the lender's primary use, right? A risk mitigation strategy.
That is certainly the primary stated function. Lenders, we're talking banks, credit card companies, other financial institutions, they use these scores to evaluate the potential risk posed by lending money to consumers. They need this data to mitigate losses from bad debt, to determine who qualifies for a loan, and then to set the appropriate interest rates and establish credit limits. It's a system built, ostensibly to protect their capital.
But there's a crucial secondary function we often overlook, one that shifts the focus entirely from purely risk avoidance to revenue maximization.
That's the key commercial insight. Lenders absolutely use credit scores to determine which customers are likely to bring in the most revenue for the institution over the long term.
So it's not just, is this person going to pay me back?
No, not at all. Consider two hypothetical consumers. One has a perfect, 800-plus score and never really uses their available credit, pays cash for everything.
Very responsible, low risk.
Extremely low risk. But then you have a second consumer who has a very good but not perfect score, say a 720, but they actively use their credit limits, maybe they carry a revolving balance occasionally, and they frequently utilize high-interest products.
The 720 consumer is a better profit center.
Precisely. Even if they pose a slightly higher theoretical risk. The scoring model, particularly in these commercially driven markets like the U.S., is often a finely tuned tool for maximizing commercial gain, not just a simple measure for preventing defaults.
I see. So they're using your score to segment you.
Exactly. Are you a prime customer who gets the lowest rate and costs them very little? Or are you a profitable customer who's going to generate interest revenue? Or are you a subprime customer whose risk just outweighs any potential profit? It's all about categorization.
And what's fascinating here is how far this predictive technology has expanded outside of traditional banking and lending. It's truly become a universal vetting tool now.
It has become deeply integrated across the entire consumer economy. I mean, we see mobile phone companies using scores to decide if you qualify for a premium service plan without needing a huge upfront deposit.
Right. That's a common one.
Insurance companies employ credit-based insurance scores heavily in underwriting policies. They argue that financial habits correlate strongly with risk profiles, whether you're insuring a car or a home.
Landlords, too, they use them relentlessly to vet tenants.
Relentlessly. And even government departments are known to employ these techniques in various capacities where financial reliability is necessary, like for licensing or certain regulatory compliance roles.
And this expansion, it feels like it's accelerating because of digital finance. The online lenders and fintech companies operate purely in the digital realm, which lets them tap into totally different kinds of data.
That is the crucial next frontier. Digital finance companies are increasingly utilizing what they call alternative data sources to calculate creditworthiness.
So we're moving beyond the traditional bank-reported three-digit score.
We really are. We're moving to systems that analyze things like your utility payments, your rent payments, transactional data from digital wallets, and even in some regions, social media usage.
Wow.
And this trend expands the scope of what counts as relevant financial behavior, making the scoring process simultaneously more complex and, frankly, far more reaching into your daily life.
To truly appreciate the global complexity, I think we have to look at the nuts and bolts, the underlying technical foundations. These models are not simple addition and subtraction.
Not at all.
Let's use Australia as an example because the sources dive into the specific statistical methods they employ.
This is where we see just how mathematically advanced these systems have become. They are not built on simple algorithms. They are built on advanced predictive statistics. While standard logistic probability modeling is still popular in Australia for developing scorecards,
Which is good for predicting a binary outcome, right? Like default or non-default.
exactly, it's very effective for that.
Yeah.
But advanced methods are also widely used by the bureaus and the lenders themselves.
And this is where the terminology gets a little jarring for the casual listener. We are talking about complex statistical tools like Mars, CART, Shade, and random forests.
I know, it sounds like a graduate course in data science.
It really does.
You're right. The names themselves are overwhelming, but the concept is actually quite accessible. Think of it less like simple division and more like using sophisticated machine learning, a kind of financial AI, to sort through thousands of data points simultaneously to find these hidden connections that influence your final score.
So it's looking for patterns.
Deep patterns.
Yeah.
Mars, for instance, that's multivariate adaptive regression splines. It allows the models to handle extremely complex, nonlinear relationships in the data.
So it's not just that high credit card usage is risky. These systems are looking for much more nuanced conditional risk profiles.
That's it exactly. They look for interactions that simple models would just completely miss. The model isn't just saying you have high debt. It might be saying high utilization combined with a specific pattern of credit card balance transfer usage focused on a certain type of retailer debt suggests a high probability of going 90 days past due.
Wow.
These advanced techniques allow them to segment and price risk with much higher precision than ever before. This complexity dramatically increases the predictive power, which, of course, is what the lenders are paying for.
And that shift towards superior precision was heavily enabled in Australia by a major policy change, the move from negative to positive reporting.
That's right. And this change is a defining moment in the modern history of credit scoring globally. Australia previously operated under a negative reporting system.
Meaning it only tracked the bad stuff.
Pretty much. It only tracked applications for credit and adverse listings, so things like defaults or bankruptcies. If you paid all your bills on time, that positive behavior wasn't recorded or used to boost your score.
And that inherently disadvantages people who are financially responsible but maybe don't have a long track record.
Absolutely. When they introduced positive reporting, the credit files suddenly contained much richer information. Crucially, a history of timely payments, the types of loans you hold, and how well you manage them.
So all that good behavior started counting.
It did. This influx of positive data drastically increased the predictive utility of the scores and led to a greater uptake in their usage, especially for risk-based pricing, where the interest rate you receive is directly tied to your individual score. This move really cemented the statistical predictive model in Australia.
Before we jump into the U.S. system, let's just make a quick technical distinction that the source material drew. We are focusing on credit scores here, not credit ratings.
Correct. We need to be clear for the listener. The score we are discussing is for individuals, a numerical expression of their personal creditworthiness and risk.
Got it.
A credit rating, conversely, is the application of this concept to organizations, governments, or debt instruments like bonds. We are focused entirely on the personal report card that defines your access to capital.
Okay, let's pivot to the model that defines the system for much of the world. The highly commercialized multi-score approach epitomized by the United States. This is the global benchmark, but it's far more fragmented than most people realize.
It really is. The U.S. system is defined by its massive scale and its inherent complexity. It relied heavily on the big three credit bureaus, Experian, TransUnion, and Equifax.
The gatekeepers.
They are the centralized gatekeepers of the underlying raw data used to calculate the scores.
And we must reiterate a crucial point that confuses a lot of people. When we talk about the core FICO score calculation, what information is specifically excluded from that three-digit number?
Yeah, this is so important. The source material is very clear. Income and employment history, or the lack thereof, are not considered by the major credit bureaus when calculating the credit score itself.
So your salary doesn't matter for the score itself.
It's not for the score. Now, a lender will certainly look at your income and job stability separately when they're underwriting a loan, but the three-digit number itself is strictly based on your credit behavior reported to the bureaus.
Things like payment history, amounts owed.
Right. Length of credit history, new credit, and your credit mix. That's it.
Now I get to the aha moment on FICO, which stands for Fair Isaac Corporation. People often talk about their FICO score as if it's this single fixed number, maybe something that updates once a month.
That is the fundamental misconception we need to dismantle for every listener. If a lender told you they pulled your FICO score, you would still need to ask which one.
Okay.
As of 2018, there were 29 different versions of FICO scores in use in the United States alone.
29?
Yeah.
That's incredible. Why on earth do we need that many different numbers to describe the same person?
It boils down to predicting specific types of debt failure. This is the concept of industry-specific scoring. An automotive lending FICO score is formulated differently than a credit card lending score, and both of those are different from a mortgage score.
So the behavior that makes me risky for a credit card doesn't necessarily make me risky for a fixed auto loan.
Precisely. The statistical weights are adjusted. The behaviors that predict risk for a 5-year fixed installment loan on a car are different from the behaviors that predict risk for a revolving line of credit that you can run up and down. The model is designed to maximize predictive power for that specific lending market.
Give us a concrete example of how that difference plays out for the consumer when those weights shift.
Okay, let's go back to our examples. Take a consumer who has a solid history of several paid-in-full car loans. This shows they're really reliable with installment debt, but maybe they have very little credit card payment history. That individual will generally score significantly better on an automotive-enhanced FICO score than they would on a bank card-enhanced FICO score. Because the automotive model is rewarding the specific, relevant, positive behavior in its wheelhouse. It sees those paid-off car loans and gives them more weight. The credit card model sees the lack of revolving credit history and might see that as a negative, or at least a neutral.
And the ranges themselves even vary depending on which version you're looking at.
Yes. The general-purpose FICO scores typically range from 300 to 850, which is the range most people are familiar with.
Right.
However, the industry-specific scores range from 250 to 900. This wider, more granular scale allows lenders to assess very specific risk profiles at the edges of the lending market.
This inherent complexity is even built into the most common lending scenario in the U.S., obtaining a mortgage. The bank doesn't just pull one score, do they?
No, not at all. For most U.S. mortgages originated, the lender obtains 3 separate scores, one from each of the big 3 bureaus.
So one from Equifax, one from Experian, one from TransUnion.
Correct, and they're often specific versions. The Beacon 5.0 score from Equifax, the FICO Model 2 score from Experian, and a Classic 04 score from TransUnion.
Why the redundancy? Why pull 3 different named scores?
They pull 3 scores for 2 main reasons. First, it's about redundancy and error mitigation. Each bureau might hold slightly different data or weight the variables slightly differently based on how the FICO formula was applied to their raw file.
Okay, that makes sense.
And second, they are mandated to use the middle score of the 3 for the primary underwriting decision.
The middle score, not the average.
A middle score.
Yeah.
This redundancy is built into the system to buffer against potential data errors or peculiarities from a single source, ensuring a more conservative and thorough risk assessment.
If we zoom out again, what is the stated objective of this entire predictive framework, specifically the FICO risk score? What is it actually trying to predict?
The stated design objective is highly specific, and it's narrowly focused on lender risk profiles. It's designed to predict the likelihood that a consumer will go 90 days past due or worse in the subsequent 24 months after the score has been calculated.
So it's a 2-year forward-looking prediction.
Exactly. It's a purely forward-looking risk prediction based on past financial behavior. A high score means a low probability of that failure. A low score means a higher probability.
Now, FICO is dominant, but they are not the only game in town. We have alternative models and, more importantly, proprietary ones.
That is correct. We have established alternatives like VantageScore, which is often offered to consumers by the bureaus themselves. TransUnion, for example, offers Vantage 3.0.
Mm-hmm.
But perhaps more impactful are the proprietary scoring models developed internally by many large lenders, especially major credit card issuers and auto finance companies.
So they take the bureau data, but then run it through their own secret sauce.
That's a great way to put it. They mix in their own customer history and statistical weights, making them true trade secrets that give them a competitive edge.
Let's quickly talk about consumer rights, especially concerning accessing this information. We need to clearly define the difference between a hard and soft inquiry here.
Yes, this is a point of frequent confusion for consumers. A hard inquiry occurs when you apply for a new loan or a new credit card. It signals to other lenders that you are actively seeking credit, and multiple hard inquiries in a short period can negatively affect your score.
Okay, that's the one to watch out for.
Right. A soft inquiry, however, is typically done by you checking your own score or by a lender pre-screening you for an offer. It does not impact your score at all.
So how does the U.S. regulate access to the data that generates these inquiries?
In the United States, Americans are legally entitled to one free credit report annually from each of the 3 bureaus via annualcreditreport.com.
One free report.
Yes, but here's the catch. They are not automatically entitled to a free score unless adverse action is taken against them, a right that was mandated by the 2010 Wall Street Reform Bill.
So you get the report for free, but you often have to pay for the score itself.
Or sign up for some kind of credit monitoring trial, yes.
But wait, if the Canadian system lets you order a free printed report any number of times in a year, and the U.S. system restricts you, why are both using the same big 3 bureaus? Is the difference purely regulatory, or is there a commercial incentive the U.S. bureaus are protecting?
The difference is primarily regulatory, but it's certainly driven by commercial protection. In Canada, the consumer may order a free printed copy of their full credit report any number of times in a year, provided the request is submitted in writing and delivered by mail.
Any number of times.
Any number of times. The bureaus must provide it. And crucially, they confirm that this request is classified as a soft inquiry and does not affect the score. This contrasts sharply with the U.S. system, where selling the score is a significant revenue stream for both the bureaus and for FICO.
The Canadian model offers far more transparency regarding the data, even though they use the same 300 to 900 score range as the U.S., using scores like Equifax Beacon and TransUnion Empirica.
Exactly. It shows that the mechanism, the score calculation, can be commercially driven, but the access rights are fundamentally determined by national regulation and the philosophy toward consumer information.
So we see this commercialized, bureau-driven model spreading globally. Let's look quickly at India and Brazil, which have adopted this structural DNA but adapted it to unique local challenges.
India presents fascinating challenges due to its rapid economic growth and, its history of cash transactions. They have 4 licensed credit information companies, with TransUnion CIBIL being the most popular, along with Experian and Equifax. The CIBIL score also runs from 300 to 900.
What's unique about the Indian system is how it handles people who are just entering the formal banking structure, the so-called thin file.
That's the crucial adaptation for financial inclusion. India has specific scores for consumers with very little history. An individual with no credit history gets a -1 score.
A -1.
A -1. And those with less than 6 months of history get a 0. This is an explicit acknowledgement that a lack of history isn't necessarily a high risk, but rather a lack of data.
It forces the system to treat these people differently than someone who has a history of default.
It does. It then takes 18 to 36 months or more to build a satisfactory score once data starts accumulating. It's a system designed to onboard people into the credit economy.
And Brazil, which has transitioned rapidly from an older Blacklist model to this predictive system.
Brazil's system is very similar to the U.S. structure now, which was a significant regulatory shift. Their scores range from 0 to 1,000. It analyzes mandatory factors like timely payments, negative debts, and financial relationships.
So pretty big change for them.
A huge change. This transition was complex, but it was necessary to modernize their lending market and shift from purely reactive debt enforcement to proactive risk prediction. It underscores the global consensus that predictive scoring, when coupled with positive reporting, provides a more efficient mechanism for capital allocation.
Okay, we are now pivoting dramatically. We've established the U.S. system is about fragmentation, proprietary models, and, maximum predictive power for commercial profit. Now let's travel to Europe, where the core philosophy shifts 180 degrees.
It really does.
Away from prediction and towards strict legal enforcement, public transparency, and robust consumer control. Let's start with Austria.
This represents a fundamental philosophical difference in how trust is defined. In Austria, credit scoring is primarily structured as a blacklist model.
A blacklist.
Yes, the system focuses almost exclusively on identifying consumers who have failed to pay their bills, and those names are compiled onto lists held by various credit bureaus.
So trustworthiness isn't measured by how well you manage credit, but by whether you've ever failed to meet a basic obligation.
That's the distinction. The score is often less predictive and more a reflection of documented unresolved debt failure. An entry on the blacklist can lead to the immediate denial of contracts, even for non-banking services.
Like a phone contract.
Exactly. Telecom carriers, for instance, use this list daily to vet new customers and avoid the risk of bad debt. While banks still use these lists, for larger loans, they typically focus more heavily on traditional factors like collateral security and verified income.
What's most remarkable about the Austrian system, however, is the strength of the consumer privacy protections governed by law. This is the antithesis of the U.S. approach.
Absolutely. The Austrian Data Protection Act provides some of the strongest consumer controls we've seen globally. The law specifies that consumers must actively opt in for their private data to be used for credit scoring or any third-party assessment purpose.
You have to opt in, so it's not automatic.
Not at all. If you don't consent, your data cannot be shared or used, period.
That is a massive level of control. Imagine being able to retroactively revoke permission for your data to be used by credit bureaus after the fact.
You can. And if you withhold permission later, any further distribution or use of that collected data becomes explicitly illegal. This speaks directly to a privacy-first approach, prioritizing the individual's control over their personal financial information above the commercial efficiency of the lending market.
So what else does that act guarantee?
Beyond the opt-in requirement, consumers in Austria have the right to receive a free copy of all data held by credit bureaus once a year, and, crucially, any wrong or unlawfully collected data must be deleted or corrected quickly. The emphasis is on accuracy and consent, and it's all enforced by law.
Now let's move to Sweden, which takes this debt enforcement approach to an even stricter state-driven level. It ties creditworthiness directly to failure to pay taxes or bills, managed through the Swedish Enforcement Authority.
Sweden's system is highly rigorous and focused on financial integrity. It aims to swiftly identify people who have a history of neglect to pay any obligation, whether it's a commercial bill or a government tax. This system is driven by the Kronofogden.
The Swedish Enforcement Authority.
Right, which collects debts. When a debt case is forwarded to this authority, that single action generates a specific record.
And that record carries the weight of the state.
It does. It is called a Betalningsanmärkning, or a non-payment record. The mere appearance of a case being forwarded to the enforcement authority, even if it is technically a company debt, results in this record appearing on your file with private credit bureaus.
And how long does that stay there?
For an individual, this record is stored for a mandatory 3 years. For a company, it's 5 years.
And the consequences of having a Betalningsanmärkning are incredibly difficult to overcome.
They create massive hurdles across your life. Having this record makes it challenging to obtain loans, secure phone subscriptions, run an apartment, or even in some cases, obtain certain jobs where you might handle cash or sensitive financial data.
So it's a major red flag.
An automatic, non-negotiable red flag for most consumer services. While banks still consider assets and income for very large loans for day-to-day life, it's a huge obstacle.
The system is so rigid that it doesn't leave much room for simple administrative error, as demonstrated by the famous case of the Swedish astronaut. This anecdote perfectly illustrates the philosophy here.
It's the ultimate lesson in administrative compliance. We're talking about the Swedish astronaut Christer Fuglesang. He received a Betalningsanmärkning because a car he owned passed a toll station for the Stockholm congestion tax.
Okay.
But at the time, he was living in the USA, training for his first space shuttle mission, and had an old, invalid address registered for the car in Sweden.
So the payment requests and the enforcement injunctions never reached him in time.
Exactly. The notices didn't reach his valid location. And here is the philosophical pivot. In the Swedish system, failure to actively dispute an injunction issued by the enforcement authority is seen as tacitly admitting the debt.
Even if you never saw the injunction.
Even then, the debt itself may have been minor at all, but the failure to comply with the administrative process was the offense.
The astronaut example is perfect. It means in Sweden, being financially trustworthy isn't just about debt management, it's about perfect administrative compliance. A distinction that would be completely alien to a U.S. consumer who has numerous rights and channels to dispute administrative errors months or even years later.
Absolutely. And despite the fact that the case was eventually appealed and the underlying tax issue was retracted, the non-payment record remained on his file for the full 3 years.
For 3 years.
For the full 3 years. Because, according to the strict letter of the law, it could not be retracted once officially established by the authority. His global fame and status were irrelevant to the rigidity of the financial enforcement system. It emphasizes the absolute power of the enforcement authority and the critical importance of maintaining a valid registered address in Sweden, even if you are floating in orbit.
We have dissected the American model of commercial prediction and the Scandinavian model of state enforcement and privacy control. Now we are diving into a selection of countries where the rules are entirely bespoke, offering philosophies that resist standardization entirely.
Yeah, these are the really unique ones.
Let's start with the UK, which has perhaps the most shocking deviation from the standardized global system. Here's where it gets really interesting.
The UK stands alone in strongly resisting the standardized FICO-style model. The key takeaway here, and it's a big one, is that there is no such thing as a universal credit score or credit rating in the UK.
Wait, say that again? No universal score.
None. The number the consumer sees is generally irrelevant to the lender.
So if a listener in the UK checks their score through an agency like Experian, Equifax, or TransUnion, that number isn't what the lender uses to decide their loan application.
That's the major point of confusion and frustration for British consumers. Those scores provided by the credit reference agencies are largely marketing tools for consumer awareness. The actual decision makers, the banks and lenders, use their own proprietary algorithms to assess potential borrowers.
So every bank has its own system.
And those algorithms are effectively treated as trade secrets.
That secrecy creates a massive commercial black box. The consumer feels powerless because they can't possibly fix or game a system they can't even see the inputs for.
That is the practical consequence. The most popular statistical technique used by UK lenders is still the foundation of modern scoring: logistic regression.
The binary outcome predictor.
Right. It's designed to predict a binary outcome. Bad debt, meaning the borrower has defaulted or not. Some banks also try to predict the amount of bad debt a customer may incur, but that binary default prediction remains standard.
But the lack of transparency seems almost deliberate compared to the U.S. model, where, despite its complexity, the FICO objective is at least clearly stated.
In the UK, lenders are under no legal obligation to reveal their internal scoring model, nor are they required to reveal the minimum score required for acceptance.
And if you get rejected?
If an applicant is declined, the lender is not obliged to reveal the exact reason why, although industry associations do require them to provide a satisfactory reason, which is often something vague like poor payment history.
So it's a very opaque system.
Extremely. This radical proprietary secrecy is built into the foundation of the UK credit system and is the antithesis of the regulatory transparency we just saw in Scandinavia.
Let's jump across the Irish Sea to Ireland, which employs a highly organized dual system that attempts to balance private commercial data with mandatory government oversight.
Ireland utilizes two parallel registers operating simultaneously. First, there's the Private Irish Credit Bureau, the ICB, which is financed by its members, the financial institutions themselves.
Okay.
And the ICB generates a score that runs in a remarkably tight range, only from 224 to 581.
That's a weird range. And is 224 good or bad?
Counterintuitively, 224 is the lowest risk and 581 is the highest risk.
Okay, so a low score is good there.
Correct. And the government's mandatory role in this dual system is the Central Credit Register, or CCR, which is maintained separately by the Central Bank of Ireland.
And lenders have to use this.
They are legally mandated to check the CCR for any loan exceeding €2,000. And significantly, unlike the ICB, where borrower consent might be sought, consent is not required from the borrower for CCR checks.
So the government has the final say on the data for big loans.
It creates a strong government-backed baseline for large loan risk assessment, bypassing the need for consumer consent because the information is deemed critical for financial stability. And information is removed from both registers 5 years after the loan is fully repaid.
Moving down to the Southern Hemisphere, South Africa is highly interesting because they leverage a wide range of data, both positive and negative, to achieve exceptional predictive power, often in a rapidly developing market context.
South Africa's system is immensely diverse in its application. It's widely used not just by banks but by microlenders, clothing and furniture retailers, and insurers.
So it's very integrated into daily commerce.
Very. And the data storage is comprehensive, including both positive and negative data, which, as we noted earlier, drastically increases the predictive power of the scores and allows for more nuanced pricing.
And this is where they have embraced advanced scoring techniques, moving beyond just payment history and debt levels into something truly unique: psychometric assessments.
This is a major innovation, and it's a direct response to the challenge of financial inclusion. Compass, one of the bureaus, introduced the Compass score PSY. This is a 3-digit psychometric-based score.
A psychometric score.
Yes. It is specifically used by lenders to make informed decisions on people with thin files, those with very little formal credit history, or those who might be marginal declines based on traditional data.
So how does a psychometric score work in this context? What kind of behavioral traits are they trying to measure when the traditional numbers aren't there?
They are essentially applying behavioral economics to lending. These scores use questionnaire data or transactional patterns to gauge traits related to stability, future orientation, and financial discipline.
So they're trying to figure out if you're a responsible person, even if you've never had a credit card?
That's the idea. They are trying to determine if a person demonstrates characteristics that correlate with financial responsibility, even if they haven't yet taken out a formal bank loan. This helps lenders responsibly extend credit to populations traditionally underserved by rigid scoring models. It's an attempt to substitute character assessment for history when history is scarce.
That's a fascinating layer, using psychology to predict financial trustworthiness. It shows the incredible lengths the industry will go to maximize predictive capacity, especially in emerging markets.
It is a dynamic response to a practical problem. How do you assess millions of people moving from a cash economy into a formal digital economy? It's a really innovative solution.
Now, turning to Asia, let's quickly touch on China and Sri Lanka and then wrap up our European tour.
In China, we focus on the privately developed credit score systems, primarily Sesame Credit, which is provided by Alibaba, Affiliate and Financial, and also Tencent Credit.
So the big tech companies.
The biggest. These are massive proprietary systems tied intrinsically to digital commerce and usage patterns. While the source material links them to the broader social credit system, our focus remains on the financial mechanism that grants access to loans and services based on purchasing and digital behavior.
And Sri Lanka, a more centralized system.
Correct. In Sri Lanka, the system is managed by CRIB, the Credit Information Bureau, which is a central authority. Individuals can request a self-inquiry credit report, though they are subject to a fee. This is a model common in many smaller economies where the state or a state-approved entity maintains the primary database.
Finally, let's look at Denmark, Norway, and Germany, which reinforce that core privacy-first philosophy we saw earlier. Denmark has a peculiar split in its scoring focus.
Danish credit scoring is divided rigorously. Private scoring assesses the probability of defaulting for an individual, while business scoring assesses the probability of bankruptcy for a company.
So two very separate tracks.
Very separate. The models rely primarily on applicant-provided information and publicly available data, but the entire system is heavily restricted by legislation compared to neighboring countries, which indicates a very cautious approach to consumer data use.
And what about Norway and Germany? They share a common feature regarding consumer rights that contrasts strongly with the U.S. model.
Both Norway and Germany ensure that consumers have the robust right to receive a free copy of all data held by credit bureaus once a year. This mirrors the privacy-focused elements we saw in Austria.
But Norway's system has a twist.
It does. Norway's scoring mechanism relies heavily on publicly available information. We're talking about tax returns, taxable income, and any non-payment records. Bidragsdanmarkning.
Imagine if the IRS published your income and debts annually. That's the level of financial transparency required there.
Precisely. It links financial transparency to credit access in a way that would be entirely foreign and almost certainly illegal under current data privacy laws in the U.S. context. Your taxable income is an explicit component of the score, contrasting sharply with the U.S. model, where income is deliberately excluded from the calculation.
It's a totally different societal choice.
It is. It reflects a societal prioritization of public information and financial integrity over individual financial privacy.
So we have just traversed a financial landscape of 14 countries, and the differences are astonishing. We've seen three completely different philosophies govern how financial trust is established globally. So what does this all mean for the learner who wants to be truly well-informed about the global report card?
It means you have to shed the idea that the U.S. model, defined by statistical prediction and commercial competition, is the template. The philosophical split is just so stark.
On one side, you have the US and the commercialized systems, like Brazil and India, focused on maximizing predictive capacity through multiple proprietary and highly segmented scores, all designed to identify both risk and profit centers.
Then on the second side, you have the Scandinavian and Austrian models, which are focused on enforcement and control. They prioritize legal debt compliance and grant the consumer powerful, active consent rights over the use of their data.
So trust is enforced by the state.
Not primarily predicted by a private algorithm, yes.
On the third side, you have the UK model, which is defined by intense corporate secrecy. The score you see is a ghost score, and the real algorithms are proprietary trade secrets that lend themselves to commercial efficiency, but offer almost zero transparency to the consumer.
And the sheer variation in the scoring scales highlights the arbitrary nature of the number itself. I mean, we've seen scores that run from 0 to 1,000 in Brazil, 300 to 900 in the U.S., and that strangely tight range of 224 to 581 in Ireland. The number is just a marker relevant to that specific national context.
And the power of that score is expanding globally, being used in incredibly diverse ways, from the standard mortgage application to psychometric assessments being used in South Africa to score people with thin files. The difference often boils down to a core conflict. How much privacy are you willing to surrender for optimized prediction?
That distinction, privacy versus prediction, is the fundamental fault line in global financial trust systems. And that leads us to a final provocative thought for you, the listener. We saw that the generic FICO score's stated design objective is narrowly focused on predicting your likelihood of going 90 days past due or worse in the next 2 years.
Right, the official line.
The official line. But we also know that many large lenders use their own proprietary algorithms, these commercial black boxes, that constantly adjust to market segments and maximize revenue.
So what does it mean for your future? And how might your financial behavior change if the calculation of your trustworthiness relies on a proprietary algorithm that constantly adjusts to market demands? The system is designed less for universal fairness and more for maximizing a lender's profit.
It raises an important question you should keep mulling over. In a proprietary scoring system, are you being evaluated primarily as a risk to be avoided or as a profit center to be optimized? That's the true nature of the global report card.